Hey, listen closely because today we are having a real talk about your future. Think of me as your older sibling pulling you aside to explain how the real world actually operates. You know I always want to see you win, and right now, you might be playing a game without even knowing the actual rules. Welcome to this explainer on Tony Robbins' incredibly revealing book, Money, Master the Game. Today, I'm going to show you exactly how the financial system works and, more importantly, the secrets the financial industry absolutely does not want you to know. So let's just dive right in. What if the financial system you've been participating in your entire life, the mutual funds, the retirement accounts, those super friendly financial advisors, what if all of that was specifically structured to transfer wealth out of your pocket and into someone else's? I need you to understand something absolutely crucial right off the bat. They aren't extracting your wealth by accident. It is happening by design. It's this massive, fundamental asymmetry that most everyday investors never fully grasp until it's just way too late. See, when the 2008 financial crisis hit, Tony Robbins watched millions of ordinary people lose their life savings and their homes. He got angry, and he made a decision right then to find out how money actually works, not the shiny version they sell us in those glossy TV ads. Over 4 years, he tracked down and interviewed 50 of the greatest financial minds on the planet. We're talking absolute titans like Warren Buffett, Icahn, and Ray Dalio. He wanted the real playbook. And what they revealed? It completely dismantled the traditional advice we've all been spoon-fed. Which brings us to our first major hurdle. Section 1, the hidden fee trap. Now 2%. Notice how innocent that figure looks. If a financial advisor or a mutual fund tells you they charge a 2% management fee, it sounds like absolutely nothing, right? Especially when you're a beginner, just trying to get your money invested and doing the right thing. You think, sure, they can have 2 cents on the dollar to manage my money. I'll keep the 98 cents. No big deal. But listen to me, that is the trap. When you actually run the compound mathematics of that tiny 2% fee over a 30-year investment window, the reality is staggering. Think about the total return of the market. Then look at what you actually get to keep versus the chunk of change paid to the industry. Because of how compound interest works, those tiny fees extracted year after year consume a devastating proportion of your wealth. In a lot of typical retirement scenarios, the fees you pay over your working lifetime literally exceed the total returns you get to keep. Let that sink in. The financial industry often earns more from your retirement account than you do. It's not fraud. It's all right there in the documents nobody reads. But it absolutely destroys wealth. Okay, so how do we fight back? Section 2, beating the casino and the 9 myths. The entire financial industry relies heavily on 9 myths. Basically, these are lies most investors believe simply because the industry profits off of us believing them. They tell you things like fees are minimal, or that brokers legally have to put your interest first. They claim target date funds are risk-free, or that you need a massive mountain of wealth to ever retire. They love to say high risk always equals high return, and that you can perfectly time the market. But I urgently want to focus your attention on the biggest illusion of them all. The idea that paying a brilliant, highly educated fund manager to actively pick stocks for you is a winning strategy. You have got to memorize this number, 96%. The data here is crystal clear and totally consistent. Over any 10-year period or longer, approximately 96% of actively managed funds actually underperform a simple, low-cost index fund. 96%. And look, it's not because these fund managers aren't smart people. They are. It's because the mathematical reality of their massive fee structure makes outperforming the market almost impossible at scale. Think of the active management industry exactly like a casino. In a casino, the house takes a small percentage of every single transaction, whether you win or lose. Now, the occasional player who wins big, they give everyone else the illusion that the game can be beaten. But the house's cut guarantees the player population as a whole will lose over the long term. Active managers are the house. The fees are their cut. But here's the secret to how you stop playing their rigged game. Low-cost index funds. With index funds, you aren't trying to beat the market. You just become the market. You remove the house's cut almost entirely, and you capture the one thing that actually builds lasting wealth: uninterrupted compound growth. Which leads us perfectly into Section 3, the all-weather garden. When you get down to it, it all comes down to asset allocation. All that really means is dividing your investment capital across different categories, stuff like stocks, bonds, and commodities. Ray Dalio, literally one of the most successful investors in human history, told Robbins that asset allocation is infinitely more important than trying to pick the right individual stocks. It's all about how you balance the risk.
So let's look at Ray Dalio's famous all-weather portfolio allocation. Think of this using a really simple gardening analogy. You wouldn't plant only seeds that need blazing summer heat, right? Because winter is eventually going to come and kill your entire garden. Instead, you plant different seeds to thrive in different economic seasons. We're talking growth, recession, inflation, or deflation. This specific portfolio allocates calculated slices of the pie to stocks, bonds, gold, and commodities. That way, no matter what the economic weather is doing outside, some part of your garden is always thriving.
All right, time to put this into action. Section 4. 5 Steps to Freedom. You're going to want to write this down because this is your insider's playbook. Here is your step-by-step checklist. First, audit every investment account you currently hold for total fees. Go in and actually add up all those hidden advisory and trading costs. Second, switch the vast majority of your capital over to low-cost index funds so you finally stop paying the casino. Third, study that all-weather allocation we just talked about. Fourth, calculate your real freedom number. And I mean your actual required monthly expenses multiplied by your expected retirement years, not whatever giant number your anxiety tells you. It's probably a lot lower than you think. And step 5, automate everything. Let me actually deep dive into that last step for a second because it is an absolute lifesaver. It's called the Save More Tomorrow plan. You need to make the single most important financial decision of your life today. Decide right now to become an investor, not just a consumer. Pick a predetermined percentage of your income to invest automatically before you even see it hit your checking account. And here's the real trick. Commit to increasing that savings rate by just 1% every time you get a raise at work. You won't even feel the pinch in your day-to-day life, but over time, you will effortlessly reach a 15 to 20% savings rate. You're basically building an automated wealth engine in the background of your life. Now, to be completely fair, we have to look at the other side of the coin. Section 5, the industry pushback. As you might guess, the active management industry pushed back pretty strongly against all this, and they do have a valid argument. In highly volatile markets or really severe economic downturns, skilled active managers can potentially limit your losses in ways that a pure passive index fund simply cannot. And on the other side, financial academics pushed back too. They warned that the specific all-weather breakdown Dalio provided to Robbins was really meant as an educational illustration. It wasn't intended to be a precise, one-size-fits-all prescription for every single investor out there. A lot of professionals also criticized Robbins' highly motivational tone, arguing that finance requires emotionally neutral, precise analysis. But Robbins' response to that criticism is actually quite profound. He points out that financial paralysis kills way more retirement portfolios than an imperfect strategy ever could. The endless search for the perfect actively managed fund or waiting for the absolute perfect moment to invest usually just results in everyday people doing absolutely nothing at all. Getting ordinary people to finally wake up and take action is vastly superior to having some perfect, emotionally neutral analysis that just sits in a drawer gathering dust. As Robbins says, an imperfect plan acted on beats a perfect plan that never starts. The fundamentals of wealth aren't actually that complicated. They are just deeply uncomfortable until you finally decide to take control. You now know that the information gap is literally the only advantage the industry has over you. So I just have one final question to ask you. Now that you know exactly how the game is rigged, are you going to keep paying the casino, or are you going to start building your own wealth today?